Ladies and gentlemen, please welcome our panelists. Founder and Group Chief Executive, Abraj Holdings, Arif Naqvi. Distinguished Professor of Corporate and Business Law, Jack G. Clark Business Law Institute, Cornell Law School, Lynn Stout. Chief Executive Officer, Sport and Lifestyle Division, and Chief Sustainability Officer, PPR, Chairman Puma, Jochen Zeitz. And our moderator, Managing Editor, Time Magazine, Richard Stengel.
Hi. You have to have the energy come up here. So working capital, creating value for business and society, right? That is our topic today. But what is our real topic? Our real topic is, what is the true role, the best role for business in society? And here's something we all know, right? The reputation of business, the reputation of private equity, the reputation of capital among people these days is pretty darn low. It's almost as low as the reputation of people in my business. But what so many people feel nowadays is that Adam Smith's invisible hand is picking their pocket. And we're going to discuss how we can remedy that, how we can make business more socially responsible. And the other thing I have to tell you is we only have a half an hour for this program, and everybody here has a lot to say. So thank you very much. Now listen up. So Jochen, you at Puma, when you were the CEO, you started something called an environmental P&L, which has gotten a lot of attention around the world, and it's also controversial. Tell the folks about it, and what have you learned from it?
It's actually not very controversial. I think everybody agrees.
I made that up.
Well, there are a lot of business people, and not just NGOs in the room, and all of us, if we ask the question, do we love nature, we would all say yes. Do we value nature? Yes. But when we do business, do we account for nature? No. And that's what the EP&L is all about. It's actually monetizing the environmental impact that you have as a business in dollars and cents. So it actually tells me where my environmental footprint is and where the damages that I cause on the environment actually happen. So when the theme of the conference is designing for impact, you have to know your impacts first. We used to say form follows function, but now we have to say, well, where are our impacts so that we can design tools, products that actually get rid of the impact. And the environmental profit and loss does exactly that. It tells me what my impacts are. For example, in our business, it would be water, it would be carbon, it would be waste, it would be pollution and land use. It tells me where the impacts actually happen throughout the entire supply chain. So I'm not just looking at my own operations, I'm looking at the raw material production all the way to the consumer, and it puts those impacts into contexts. So rather than talking about liters of water and cubic meters of pollution or hectares and acres or carbon tons, I'm actually putting those values into a relation by saying everything has a monetary value and where is my biggest impact? And that's exactly what the EP&L does. So it really, in very simple terms, tells me as a CEO on one page, here's where my impact, this is what I want to do about it and have to do about it. But the interesting bit is really that, having run a business for 18 years as a CEO, I thought I know my business. Reality is, when I saw the results of the EP&L, I realized that I actually don't understand my business at all because the impacts that I have on the environment were very different to the impacts where they actually happened. I thought my operations would have a much bigger impact. Reality is, my operations only have 6% of the total environmental impact, which means if I'm going out with a bold statement of saying, I will make my operations carbon neutral, or I will have a zero impact as a business, it really means nothing because that impact is only 6%. The real impact actually happens with the decision what raw material I use and how I process it, because that's where 75% of the impact actually is. So I'm saying if every business does an environmental profit and loss, we know where our impacts are, then we can design products to actually find solutions to our problems. And that's what every business should do.
Now, Lynn, for this to really work, right, the consumer has to know about it, and the consumer has to appreciate that value. Lynn wrote a fantastic book that came out this year or last year, The Shareholder Value Myth. So I work for a public company, and everything is always justified by creating shareholder value, even if it doesn't create consumer value or value for the folks who work for the company. So I'd love you to talk about what that myth is and explode it for everybody.
And I'd like to start by pointing out something that's obvious and maybe doesn't need saying, but I'd like to say it anyway, which is there's a lot of problems out there in the world, but we make a mistake if we ignore the possibility of bringing business to bear to solve those problems. Business in general, corporations in particular, actually have enormous potential to contribute to peace and prosperity and well-being in the world. I was listening to the president talking about human trafficking, and of course, one of the things that contributes to making human trafficking possible is the lack of good employment opportunities. And when there's good jobs, trafficking becomes less appealing and more difficult. So we've got these institutions, corporations, that are capable of doing enormous amounts of good. But I think one of the biggest obstacles they face is actually this myth, this idea that a corporation is run well when it's run to maximize stock price. And people may not know this, but first of all, this is not what the law requires. And it's never really been what the law requires. The law makes it pretty clear that the directors of the company, as long as they're not lining their own pockets, have legal discretion to run the firm in the best interest of the firm. But what many people also may not know is that this idea is pretty new. It actually doesn't really show up in the business world until the late 1970s, 1980s. And it came not from the business world itself, but actually, I'm embarrassed to admit this, it came from professors. So you should know right then that maybe we should be a little worried. But we certainly should be worried because we've now had 25 years of asking the people who run our corporations, the directors, the executives, the lower-level employees, we've asked them to focus on shareholder value, and it's time for us all to admit this is not working out well. We know it's not working out well for employees, but what many people don't know, although I'm sure you've noticed the last 10 years, it's not working out well for investors either. Actually, returns to investors from ownership in public companies have declined significantly in the last 30 years compared to the history before then. It's not working out for the companies. Many people don't know this, but actually public corporations are disappearing. There were 8,800, it was actually 8,823 public corporations in 1997. By 2008, that number had declined to 5,418. If this were a species and we saw the population drop by 40%, we would say it is endangered. So I think this idea that companies are run well when we maximize share price, it's not based in law. It's actually not supported by the evidence. And it is keeping our public sector, our public corporation sector from doing as much as it could to contribute to solving the world's problems and making things better off for all of us, not just perhaps for a small group. So I'm very enthusiastic when I see executives and firms that are willing to go against the tide of this shareholder primacy ideology and say, no, we're thinking for the long term. But they do face one really important structural problem, and that is that one of the biggest obstacles to long-term thinking, one of the biggest obstacles to allowing our corporations to reach their potential is the fact that not only do we have this ideology of maximizing shareholder price, share price, but we've also made it extremely difficult for people in business firms to do what they know they ought to do, to focus on the long term, because they are increasingly beholden to this ideology and to investors themselves. And here's the irony. In 1960, the average holding period for a share of stock was 8 years. Today, it's 4 months. And it is very, very hard for the people who run businesses to think for the long term when they look at their shareholder base and they have to worry that their shareholder base is thinking that short term. So this is a structural problem. I'm not going to fault the shareholders. There are reasons why the holding period has declined. But until we can fix that problem of investor short-termism, which is, by the way, I think eminently fixable, it's going to be very hard for our business corporations to take the long term and to make the kind of responsible, sustainable decisions that we actually want them to make.
And of course, maximizing shareholder value maximize the CEO's salaries, which is another part of this whole equation. So, Arif, you've started a global investment company, and one of the things that you talk about is the inclusive stakeholder, which I think is a great phrase for one of the things that we're talking about here, socially responsible business, the role of business in terms of helping everybody, not just helping those who work for it or the people on the board. I'd love you to talk about that.
So it was actually quite simple to get involved with thinking in terms of inclusive stakeholders, because when I got into the private equity industry about 10 or 12 years ago, I'm one of those people who didn't even know what private equity was. So I got into it by accident, and I realized that too much of the industry is part of the financial industry sort of center space. And as far as I'm concerned, the private equity industry is there to generate long-term value in the businesses that it invests in, not necessarily for its managers. And the second part of what I saw when we were designing the strategy was that almost everyone around the planet over the course of the last 8 to 10 years was guilty of greed. And that led to short-termism because it was instant gratification. Now, I was lucky enough to be in an industry where we could take the long view, we could take the 10-year view, and because of that, we felt it's crucially important to think stakeholder, think inclusiveness. Why? Because sustainable businesses lead to sustainable society. And in the part of the world where we operate across what people refer to as emerging markets, we call global growth markets, because this is where the opportunities in the future are going to be. And across all of them, the necessity to think from a stakeholder perspective is just so much higher. We don't focus on financial engineering or leverage to generate our returns. We're lucky because we're still in a part of the world where growth is so dramatic, where multiple expansion is possible, operational enhancement is possible. And because of that, we felt it extremely appropriate to look not just at the need of the shareholder, but look at the needs of all the stakeholders around us, because by doing that, we were going to maximize value. And the last point on that is the net impact of all of that is outside of developed markets. We want to be the people that define what the private equity industry is, which is that it actually is a part of Main Street. It isn't a part of Wall Street.
Mm-hmm. So I'm going to get back to the discussion in 1 second, because we're going to have a report back from Hikmet Ersek, who is the CEO of Western Union, who led a group along with President Clinton yesterday of, I believe, 32 CEOs talking about this very subject. Hikmet.
Thank you. Yes, we did meet about 35 CEOs with President Clinton, and it was a very interesting meeting, actually. It was dynamic. It was a hard talk, but a fair talk. And we did focus on the long-term sustainable solutions. The entrepreneurship, first thing was that let us be business leaders. Business leaders are here to drive business, to create jobs, and drive the business for the shareholder value. If you don't do this, we said all together, we are not business leaders anymore. We are going to be only survivors. And as business leaders, we have to have an environment which allows us to grow to business. And we don't see it today, and we have to create that environment back again. One thing we agreed also is that the solutions won't kick in immediately. We have to be patient. It will take some time until they kick in. And President Clinton made a very good comment saying that we should bring the economy back. We need to discuss, not to bring the economy back, we need to discuss how we bring the economy forward. And solutions must be 21st century focused. We have to definitely find some short-term approaches, but we have to get to long-term solutions like the education. And there is a customer segment, sometimes we in corner offices forget them. There is a customer segment which is global, which is young, dynamic consumers from different segments and different demographics, and they present a huge opportunity for business leaders and for the society. We also talked about sometimes we forget our own employees, because sitting there, their own employees are the global consumers. We as business leaders have to take the opportunity to invest in the education, and investing in our own employees is education actually. Develop their skills and workforce. Education is definitely a key, strong driver for the economy. And last but not least, we also talked about that mission-driven companies have the best ideas and attract the best people, actually. The young generation, the new generation, are joining companies not only getting high salaries, they do want to drive the shareholder value if the company is mission-driven. They do want to give back to the economy. They would like to provide economic dignity, not only for themselves, for all. And this is what we see also as new employees. So it was very 2 hours of discussion, very intense discussion. We had government, we had business leaders, we have NGOs, and we had the hard talk, but very fair talk. And I think everybody agreed that we have to act now. We can't wait anymore, and we need solution-oriented discussions.
Hikmet, thank you. So I'm going to ask a contrarian question of you, Jochen, that we're in the business world. We have to make a profit. Yes, we can't do it all for shareholders, but you were running a company and you brought back Puma, right? You were selling sneakers. I know because my kids started buying them after a few years. Now, you had to sell the sneakers in order to justify doing all that socially responsible stuff, right?
Yeah, of course. But ultimately, having been CEO for 18 years, it's kind of you think long term. And I always thought, that my goal is not just to, optimize the bottom line, but really contribute also to the greater good. And initially, I didn't think that business can actually change the way business is done, other than with your own brand and products. But I came to realize, growing of age, that I can actually contribute to really changing the way business is done. And I think that's what we need to do. We all realize that things need to change, but we have to have tools. We have to have tools that can help us to really get us to close the gap that we all know that all the problems exist, but what we are doing is really not enough. So what are the tools that take us to the ultimate, I don't want to say solution, but help us to find solutions that will ultimately lead to bigger results? The environmental P&L is one of those tools because it just tells you where your impact is. Of course, you have to take the consumer onto that journey as well. And I think that's the next step that we need to do, is to actually break down the environmental P&L for the consumer, so that the consumer down the road can say, just like you find calories on a cereal box, what is the environmental impact measured in calories that a product actually has? And if we can standardize that rather than having 50 different green labels and this and that, and actually say, well, let's translate our environmental footprint onto our products and tell the consumer that what you are buying has an impact X versus an impact Y. We're actually giving the consumer a tool to decide which product to buy. If we can standardize that, if we can scale that, if every business was transparent, and it is a matter of transparency, we as businesses have to be transparent. And it's very painful to be transparent because it opens you up, towards criticism of the media. Everything I know as a CEO in my supply chain, not everything is great. But we have to be transparent about it. And those that don't want to be transparent about it have to be made transparent, meaning we need some regulations. And then we need to take the consumer on the journey, because the consumer ultimately decides what they should purchase. And that's our job, because consumerism wasn't invented by the consumer. We invented consumerism in the first place. So we have to find the solutions.
So Lynn, how do we educate the consumer? I mean, we can't just assume that given perfect transparency and these two mugs, I'm going to choose this one because it was created in a responsible manner, even though it's $1 more than this one. How do we get people to opt in for that kind of thing?
Well, in fact, just letting them know that one of the mugs was produced in a responsible fashion will make a big difference. I'm pleased to report, even though most economists assume that people are rational and purely selfish. They're mostly rational, but I'm pleased to report they're wrong on the selfish part. I mean, the reality is we now have extensive data. 97% of the people in the world are capable of thinking about the future, thinking about the planet, thinking about something other than their narrow economic interests. And also, because they are at least somewhat rational, they can understand that sometimes pursuing a short-term profit ends up coming around and hurting you in terms of harming your long-term interests. So I actually think that information is really key. One of the reasons why we have this relentless shareholder value ideology is that the only kind of information that corporations are required to publicly report is economic information and profits. So where's the surprise that that's what people focus on? So generating information about other elements of corporate performance is actually really key to unlocking our human potential to act as if we have a conscience. Oh, by the way, I mentioned that 97% of people are capable of acting as if they have a conscience. The other 3% are called psychopaths, but you know, they're a relatively small percentage. So I think that's a lot of it. But then the next trick is we have to make sure that corporations and long-term investors have breathing room to pursue a broader vision of corporate purpose.
So yes, right. So does that animate your decisions about what to invest in? I mean, how does that work at your level, Arif?
But of course, I mean, when you see the opportunity to be able to bring tangible change in a corporation and potentially in the environment that it influences and operates in, you find that there is a very tangible reason to invest on its own. I'll give you an example. We have a fund in Africa which is focused only on healthcare, and its entire objective is to find sustainable businesses that are profit-driven but at the bottom of the pyramid. Now, the great thing is that we managed to find investors, such as the Gates Foundation, such as the IFC, that were quite happy to look at a relationship with us where not only was financial return a benchmark, but also the impact that we were having at the bottom of the pyramid. Now, that's not very often that you will come across investors that are capable of thinking like that. But when you are looking at a 10-year investment cycle, it becomes crucially important to look at investment opportunities that not only are driven by the profit motive, but because they are thinking in a sustainable manner, we're very clear in our minds that that leads to further value generation.
But but do you balance that out by saying, yes, I have this one socially responsible fund, and that means I can have this rapacious fund on the other hand, and they balance each other out?
No, it's a mindset. I think in a business like ours, we tend to find that we create the maximum long-term value by all of us, all my colleagues, myself, and all the companies that we invest in thinking similarly. So, for example, what we find is we don't call companies that we invest in portfolio companies. We call them partner companies because they are as responsible for value generation as we are. And because we want to infiltrate our virus, we call it, into their thinking in terms of thinking sustainably, thinking long-term, thinking strategic stakeholder value enhancement. Because of all of that, we find that the relationship becomes that much closer than in the traditional private equity model.
So we're in the middle of a presidential campaign now. We had the president here a little while earlier, and people are talking about GDP, they're talking about unemployment numbers. People don't necessarily want something that is socially responsible. They want a job, or they want the GDP to grow. Inside, beforehand, we were talking a little bit about contrasting the German economy with the American economy. And I think people look at the growth in Germany, but they probably don't realize that there's actually a different model there.
Historically, it's been very different, at least over the last 30 years. And the German model has always been something of a stakeholder model, where managers think about taking care of their customers, their suppliers, their employees, as well as their shareholders. And the irony is they actually do better for shareholders than this short-term shareholder value ideology that's been so dominant in the United States in particular.
Because they're utterly driven by thinking long-term.
Right. And if all investors were like you, our U.S. corporations would also think long-term. But the question I have for you is it possible for an investor to take a long-term frame when you have to worry that some other short-term rapacious shareholder is going to show up that's paying attention only to the financial performance and not to any of these other elements, and is going to put pressure on the board to abandon its long-term plans.
Well, let's be honest.
But the reality is,
it's going to be a long-term educational process. It's not just a firm or a group of people acting in a certain manner. We have to remember we invest money that is given to us by other investors. The issue there is, when will pension funds, when will long-term mutual funds, when will the strategic investors that put money into this asset class start thinking this is not a financial return story, this is a societal story, and more importantly, this is a story where returns are generated over 10 years, because they in turn put pressure to generate returns quickly, and that, I feel, impacts the model and the business continuity negatively.
Yeah. And I think education is key.
And
but
we actually have
a German
businessman here, so you can actually speak about it from first-hand experience.
Well, the reality is, our shareholders, our analysts, and our media are asking exactly the same question. Yes, we're talking about the social market economy in Germany. We're not talking about a free market economy. It's a social market economy. I'm saying we actually need to talk about a sustainable market economy. But analysts are asking the same question. What do you care about sustainability? It will have an impact on your bottom line. And the press is saying, well, if you are actually caring for sustainability, that'll cost the company money. So we are being asked exactly the same questions. And the reality is, I think we really have to call a spade, because sustainability and making your business truly sustainable will cost money. Just like every business needs to invest in something. It needs to invest in R&D, into new products, into new services. Sustainability doesn't come for free. Very often we talk about making our businesses more efficient. Yes, we can save money, we can save energy. But the reality, if you really want to transform your business, it will cost you money. Now I know where my impacts are. I'm using cotton, I'm using leather, I'm using rubber.
Right.
If I use sustainable materials, they don't come for free. They will cost more money. So you will have to realize that, yes, there are huge opportunities out there, but we can't just walk around and say sustainability will always be great for business. There will be businesses that will benefit because they build their business model entirely and newly on sustainability, and there will be a company down the road that will be the truly sustainable Apple.
But there are many aspects. There are many aspects to sustainability. So it doesn't always have to cost more money.
No, I'm not saying that. I'm saying it does also cost money, and if you have to invest into it. There are businesses that will make money, but there are also businesses that realize to transform your business model and to really find new materials that are more sustainable, less unsustainable, requires investments. And I think we just have to get away from saying sustainability is good for the bottom line. It can be good for the bottom line. Long term, it will be good for the bottom line, but it's an investment as well.
Although sustainability is the ultimate pragmatism, because if you go out of business and you don't sustain it, that is absolutely the alternative of what you want. I mean, I talk about in my world where people are going out of business all the time, I always say sustainability is the first goal.
Sure, but if we know that our investors are holding our shares only for 4 months, that's not sustainable. Right. So we have to think long term, and we have to balance the short-term pressures that we have as CEOs, as businessmen.
But that's where
but let's get practical, right? What can governments do? Is regulation playing a role here? What can we do in a very practical way to start all of this happening right now?
We need to understand that business people do want to be sustainable. They want their corporations to survive, and we need to identify the obstacles to that. So I've already mentioned one, which is this very short-term holding period. That's actually easy to fix. I would recommend, number one, a stock transfer tax if people are selling stock that they've held for less than 5 years. I know it's not popular with Wall Street, but there's lots of reasons to think it would actually be a good thing for investors and for Main Street. You've mentioned one of the problems, another obstacle, and that is the way we compensate CEOs. The reality is that executive pay, unfortunately, is still tied to relatively short-term metrics, and so we need to remove that as an obstacle to long-term thinking.
Guys, the business driver of economies, whether it's the United States economy or any other economy, is not public companies alone. What you're talking about are public companies. There is a whole host of businesses out there, which is the real engine of growth, which are non-public. Sometimes referred to as SMEs, sometimes referred to under the general banner of entrepreneurial companies. These are people who are actually beginning to put sustainability at their core. I'll give you one example, and it's non-United States. We invested in a business called Brookside Dairies in Kenya. Today, it's one of the biggest dairy businesses in Africa, but guess what? From day one, we were buying from local farmers. Today, it's up to 100,000 local farmers. And that's a sustainable business, and that didn't cost more money to build.
But the reality is businesses are lobbying and spending millions and billions of dollars to actually prevent good laws to become practice. So there are great tools, and the environmental P&L is just one example. There are perverse incentive systems for very good reason, because some businesses do not want good laws to be passed. So we have to reverse it as businessmen. If we're truly responsible, let's turn lobbying around. Let's lobby for positive regulations, because if we change the playing field, it's just like in a sports game. You have to change your rules if your game becomes faster. If you don't do that, the rules, the game itself won't change. And there is too much lobbying going on that is actually having a negative effect, is holding good regulations back.
So it comes from government. In other words, most businesses employ accountants, they employ lawyers, they employ bankers, right? And what do the accountants do? They give you your audited report saying you did well, here's your snapshot. And they do that on the basis of what are called accounting standards. Why can't government impose environmental standards that businesses also have to report to? Because if it's imposed, it gets done. And
but there's one other thing we need to bear in mind. I want to respond. You're right. Private companies do well, and there's some evidence they are actually more socially responsible than public companies, but there's one thing they can't do. Private companies have a tendency to make money for people who already have money. The great thing about a public corporation is that historically, because it can sell shares to the public, it's been a vehicle for generating wealth for a much broader segment of society. And that's why I'm all in favor of private companies, but I think it's a tragedy that our public corporations are disappearing.
But you seem to be thinking from the perspective of big business. At the end of the day, the majority of business is run by sole entrepreneurs or sole proprietors that employ 10 or less people. That is a statistic from across the world.
So let's change the accounting rules so that accountants can save the world, as Peter Parker said. Accountants can save the world because if we account for the impacts that business has on society, on the economy, and the environments, we will actually contribute to making the world a better place. But we have to change the accounting rules, and the EPNL does exactly that.
Absolutely.
Now, speaking of regulation, I have to regulate the panel now. And we should actually have a second panel talking about practical solutions to all of these things and what we can do. So thank you so much for paying attention. I forgot to, you recognize this guy? So he is at the center of this new global wheel that unites business and governments and philanthropy. And thank you all for participating. Thanks for a fantastic panel. Have a great day. Okay.